Hi guys, Davis here. So in this video, I'm going to give you a step-by-step guide to selling covered calls. So what we're going to do is, first I'm going to just share with you what is a covered call, why you want to sell a covered call, and how you're going to sell it. And then we'll head over to the TD Ameritrade platform, and I'll show you some of the covered calls that I've sold. I love covered calls a lot, and I'll also show you how you can start placing your covered call as well. Alright, so first of all, what is a covered call? So basically, a covered call is selling a call option against either 100 shares of stock or a long call option. If you were to sell it against a long call option, this would be what you call either a diagonal spread, or some people call it a poor man's covered call. So when you sell a call option against your position, you want to always ensure that you have 100 shares of stock. If you do not have 100 shares of stock or at least a call option, you're going to have a naked call, and this is a very dangerous position to be in, especially if you don't know what you're doing. So always ensure that you have 100 shares of stock first. All right. So with a covered call, basically what you're doing is you're selling the right to buy the underlying stock at the strike price. So as the seller, you have the obligation to sell the underlying stock at the strike price that you've chosen. So here's an example. So let's say you have bought IBM already. You have 100 shares of IBM. The current price is $137.50. Now, you sold a covered call at the strike price of $142 with a DTE of 30, which just means there's 30 days to the expiration of this covered call, and you collected a premium of $2.04. And because there's 100 shares for every option contract, so you're actually collecting $204, right? So it's $2.04 times 100. So at expiration, there's only two things that can happen, right? If at expiration, if IBM is above $142, you are obligated to sell your IBM shares at $142. So what if your stock shoots all the way up to $200 or $300? Well, you have to sell it at $142 still. So this is the option contract which you have did with the buyer of your covered call, right? And if IBM is below $142 at expiration, well, you get to keep your shares and you get to keep your premium as well. So it's very simple and it's very straightforward. So why do you want to sell covered calls? So there are basically three reasons that I can think of. So number one is that you get consistent income. So if you can keep selling a covered call every 30 to 40 days to expiration cycle, well, you're going to keep collecting premium over and over again, and this premium can help with your cost basis reduction as well. So that means that the premium which you buy actually offsets the cost price which you bought your stock at. So let's say if you bought your stock at $100, you collected $2 premium for it. Essentially, you have bought the stock for at $98, right? So this is so much better than if you were to just buy long stock and just hold it, and just, you don't really get any cost basis reduction on it. And reason number three is you get paid while waiting for your stock to hit your profit target. So if you are doing trading, normally you would place a limit order as your take profit order, as a place where you would, get your to close your position and take a profit, right? So instead of placing your limit order to take profit, what you can do is sell covered call at your take profit price. So this way, if the stock does not reach your profit target, you can still collect the premiums over and over again until the stock finally hits your profit target. So this way, not only do you get the capital gain on the stock, plus you also get all the premiums that you have collected while waiting for the stock to finally hit your profit target, right? Alright, so this is the P&L graph for long stock. So I'm using the example of IBM again. So if you were to buy the stock at $137.50, you can see that it's just a very straightforward P&L graph. If the stock goes up $1, you make $1 on every share you have. If it goes down $1, you lose $1 every share you have. Nothing is particularly against you, but there's nothing for you as well. But if you were to sell a covered call, let's say you were to sell a covered call at 142, and you collected a premium of $2.04, so that is $204. You can see the P&L graph right here, right? If the price does not move, you still are in profit. Whereas if the price didn't move, you would not be making any money. But with the covered call, you can see that because you have collected the premium, you will be in profit, even though if the stock doesn't move at expiration, right? And if the stock were to go up, all the way to your strike price. The thing is that you will be capping your profit at this price, because then your stocks would be called away. Remember, you have the obligation to sell your stock at this price. That is why you see this flat line here. That means to say that if IBM was to go all the way to 149, your profit would still be maxed out here. That is, of course, if you do not roll your cover call. But that's a topic for another time. But basically, if you were to roll your cover call, you can extend the duration and the time of your profit again, so that your long stock can continue to make more profit as the stock appreciates. The other thing that's good about the cover call is because it reduces your break-even price. Basically, it's the cost basis reduction I talked about. You notice that for long stock, this is where your break-even is. Basically, it's at the place where you bought the stock at. But with a cover call, because you already collected $2.04 for the premium, your effective price of your stock is lower at $135.50 thereabouts. Right? That's because you've collected this. So imagine if you were to collect your cover calls over and over again every 30 to 45 days cycle. Right? This break even will get lower and lower and lower. So you have effectively lowered the cost of your stock purchase, which increases the profitability of your stock position. Right? So it is always the reason why I tell people that you need to sell cover calls if you have 100 shares of stock. That's the best way for you to hold a stock position. So how do you sell a cover call? So there are 5 steps. So the first step, very important one, is to make sure that you have 100 shares of stock or a long call against it. If you don't have, you have a naked call position, and you better know what you're doing. Otherwise, you're going to really lose a lot of money. Right. Step number 2, you want to look for days to expiration, 30 to 45 days out. That's generally the optimal number of days you want to sell, because you get good premium as well as you have a pretty decent theta decay as well. Now, step number 3, you want to identify where you would like to sell a cover call. Basically, this is the strike price where you want to sell it. Typically, I like to look at the delta, which I will explain more a little bit later when we get onto the platform. But basically, I like to look at a delta of 15 to 25. Some people like to go for a higher delta or a lower delta. This is a really very personal preference, but I think 15 to 25, if it's a good place for you to sell your cover call, if you still plan to hold your stocks for a long time, right? Now, step number 4 is to look at the mark of the mark of the option, and then place limit order around the mark. Then after that, you just adjust, lower the mark until lower the price of your limit order until you get filled. So let's head over to the platform now. I'm going to show you some of the cover calls that I've sold and how you can go through these 5 steps to sell your own cover call. Okay, so this is the TD Ameritrade Think or Swim platform. So as you can see, I've got a number of positions I've put on here in my account. You can see that these are all my long stock positions right now. So these are for the long term. And the thing is that I only want to sell cover calls on shares which I have 100 shares of, like I mentioned before. So you can see I've only got some of them that I've got 100 shares or more. Most of them have under 100, which I'm still accumulating over time. So I'll only sell cover calls on them. So you can see that I've sold 2 cover calls here. One is on GXC, the other is on ITA. So don't be fooled by the number here, because you see that although it is losing money, the thing is that because it moves towards your cover call price, which means that your overall stock position is in profit. So if you were to put on a cover call and you were to see that your P&L open is losing money, do not panic, because this is a good thing. You want the stock to actually be moving towards your cover call where you're getting a profit, that is. So you can see that I sold ITA down here. I sold the cover call for $1.15, so it's about $115. I have on GXC as well, $125. And apart from the shares, what I did is I sold what you call I bought what you call a poor man's cover call. So basically, what I have is long stock, a long dated call option. As you can see, it's a very long dated one, 480 days, and I'm selling a cover call against it, a shorter term days to expiration down here. So for Apple, you see I've collected $2.60, so 260. I have ASHR at Boeing. I love Boeing. I think it's a good stock as well, and $7.79, what I got it for. So that's $779. You can see the position is up. That means because the stock has gone up to roughly where my cover call is. You have Baba, which right now has been taking a big hit, but I'm not worried about it because I still have a very long time, and I think this is a fundamentally good stock. So while waiting for the stock to finally recover, I'm selling covered calls on it. So this is very important, especially if you're doing investment, you're planning to hold the stock or the call for a long time. What you want to do is sell covered call to reduce your cost basis. At the same time, you get some income along the way, right? So Baba, I've rolled quite a number of times already, so you can see the premium for this is $3.56, which is 356. Have quite a number of Facebook as well, good premium as well, $772. JD, JNG, LMT, $3.18. XBI, $2.18. So you can see I've sold quite a number of covered calls here. I've also have some covered call variants where I use the premium from the cover call to buy a debit spread. So this is basically a call ratio position. So what I did is I sold cover calls. You can see I have 4 cover calls here because I have 400 shares of IWM. You can see here I have 400 shares of IBM. That's why I sold 4 calls against it. So I have 4 cover calls, and I sold with the premium I used half of it to go and buy a debit spread, a call debit spread. So this becomes a call ratio. So you might see that I'm losing $339 here, but do not be fooled by this again, because this is a very profitable position. Let me just show it to you. You can see. Alright, so you can see this is IWM. So you can see I've sold 4 covered calls on it, and I bought the debit spread. So how does a debit spread look like? Basically, it's just this, right? It's just a call vertical. It's debit spread. So I paid $412 for this spread using the premium which I collected from here. So 4 cover calls on this, which I collected $2.50 each, which is a total of $860. So I used half of that to go and buy the debit spread. So you can see that this is where the price of IWM is right now, and you can see this is the sweet spot of where it is right now. So that means to say that if IWM stays here at expiration, then you can see down here, look at the blue color number here, is at expiration. I would be making $1,249. So this is one way that you can use the cover call premiums to manipulate certain positions, and that is the beauty of the options. But this will be a topic for another time. If you think you're interested to find out more about this, maybe you can just let me know in the comments below, and I'll probably make a video about it as well later on. Alright, so I just want to go to the how to place a cover call. Alright, so I'll go over to IBM. Alright, I just use the same example as before, and I'll do all groups. So the first thing you want to do is, remember, step 1, ensure that you have 100 shares of stock. Right, or maybe even a long call on it. Next, you want to choose the days to expiration. So you can see the days to expiration just from the numbers here. So ideally, we want to go for anywhere from 30 to 45. So in this example, I'll go for the 32. So for 32, the next thing you want to do is look at the delta. So this is the delta down here. So you can see all the numbers here, right? At the money, basically it's where the option is closest to the current strike price. Right now the market is closed, so it closed at 137.49. So roughly this is where the at the money calls are. So you can see at the money call deltas is roughly 48 to 52. It's always around 50. So what you want to look out for is 15 to 25 deltas. So anywhere, these 3 options would be good candidates for me to sell a cover call if I was to sell a cover call on this stock on IBM, right? So if you want to sell a covered call on this, either of this would be good. So the next thing I'll look at is basically the mark. Remember, the next step is to see the mark, which is basically the mid price of the bid and offer, right? Because you do not want to sell directly at the bid, because that is the bidder spread. If you were to sell this and buy immediately, you will lose 30 cents, and that's not what you want. So you want to make sure that you place it at the mark. So if you want to buy, if you want to go ahead and place this cover call, click on this down here. and you can see it says sell one call at 145, and this is the premium that you receive. Now remember, this is the bid price. This is the market price. You want to do it at the mark price. So the mark price will be at 125. So what I'll do is I'll adjust it to roughly around 125. And if you're okay with it, all you have to do is just hit the confirm and send, and you will see all the details that you need to know down here. So you can see that the credit they will give you is $125 minus off the commission of 65 cents, and that is $124.35 credit, and that is into your pocket. Alright, so this is how you place a covered call, and you can see down here the buying power effect is minus $2,000, and that's only because I do not have a position in IBM. If I have a position in IBM, then there would be no buying power reduction. Okay, so once I'm okay with this, all I have to do is just click the send button, and then it will be placed as a limit order. And what I'll do next is basically just adjust the price, because not all the time you will be able to get filled at the mark price. Sometimes you get filled at the mark price, sometimes you would be filled slightly higher or lower. So what I'll do is that I'll just put up the order and just wait for maybe 30 seconds or a minute or so to see whether I get filled. If I don't get filled, I will just adjust it. I'll adjust it to maybe 20 cents and then try again. If I still don't get filled, I probably try and adjust a few cents lower again, but I'll try as much as possible to try and stay at around the mark price. And remember, the market, when it's open, it's always moving back and forth, so the price will be changing all the time. So the best is to just put around the mark price and just adjust a little bit each time down until you finally get filled. Alright, so that's how exactly you place your covered call. So if you like this video and you found this video helpful, please subscribe, and please hit the thumbs up as well. And if there's any questions that you have, please just leave it in the comments below. I'll get back to you soon about it, and I'll see you in the next video.